All right, today is February 3rd, and welcome to the fourth week. We are trucking right along in this semester. Everybody's been keeping up mostly with the assignments. I've seen very few late ones roll in. I am assigning some academic penalty to the late assignments, although I'm still accepting late assignments at this point in the semester. I understand that when people enroll in an online class, that to a certain extent, one of the reasons that they want an online class is flexibility. So to the extent that I can, I'm fine with accepting late work, acknowledge that it might be for a reduced grade, but I'm happy to build in that level of flexibility. Also, if you have something come up in your life and you notify me in advance that you will, for some reason, be turning in something late, I might even waive the academic penalty for lateness. So the more you communicate with me, the better. I think it's in your best interest if you foresee that you're going to miss a due date of some kind. If you think there's a good reason for it, you're attending an important event, you had a family emergency, you had a doctor's appointment, any of those things seem very reasonable for me to give an extension 24, 48 hours, depending on the scenario. And then I won't lower your grade for late work. Okay? Today, the stuff from last week is due, and I'm going to go ahead and post the new assignment. This is the first time that we've had a weekly assignment that's not the typical one-page response paper. Instead, what I have uploaded, consistent with the syllabus, no surprises there, is a list of short answer questions. So you'll probably be doing about the same amount of writing, but it's going to be over a multiplicity of different topics, going back all the way through all of the chapters so far. So chapters 1 through 5. There's just a few questions from each chapter. So pretty straightforward assignment this week. Just open up assignment 4 in the assignments and download that Word document, and then just type in your answers into that Word document and send it back to me, the same as you would any of your one-page response papers. We'll also have, as always, a discussion board this week, specifically over our Chapter 5 stuff, which is the drafting of contracts. The book tries to make it easy for us by talking specifically about shipping contracts that we call bills of lading, which is a form of doing a documentary sale. And I like that because instead of talking about all the different possible ways of doing a transaction, we can focus just on one and learn all the same principles from that one simple transaction. So, you might have learned by now that practically all of international business law is about mitigating risk. Okay? The reason that we create all these rules and the reason that we have all these different forms of contract interpretation and contract drafting, and why we're learning about dispute resolution, litigation, arbitration, etc., is because doing business abroad carries some risk, right? You risk as a seller not getting paid by the buyer, right? You risk as a buyer that you will not receive delivery of the goods from the seller, right? Or in all types of transactions, you risk not receiving the amount of money that was promised, or not receiving the type of cargo that was promised, right? So all of international business law seems to be related to the mitigation of risk, or the management of risk, or the predictability of risk, okay? Everyone who does international business understands that these transactions come at somewhat higher stakes than domestic transactions, and that they are more complex than domestic transactions. And it might be harder to find a trustworthy business partner than a domestic business transaction. Okay? We define types of transaction risks as either delivery risk or payment risk. So a delivery risk is specifically a risk to a buyer that a failure fails to ship, or fails to ship on time, or to ship it properly or safely, or to ship the right amount of the product. And then payment risk is the risk of the seller to the buyer that they might not pay, or they might not pay as much or correctly or in the right denomination, or that there could be some type of economic catastrophe that lowers the value of the currency that they pay in. Okay. Now, when we're talking about shipping goods abroad, here's one important point. Most international trade still takes place literally on a ship. Certainly a lot of international trade takes place with trucking and through air cargo transport. But interestingly, most international trade is still done the old-fashioned way, the same way it was in the 1600s, on some type of large cargo vessel. So a lot of our maritime law that really is merchant law has helped to shape international business law over the past 400 years through the practices of companies using shippers as intermediaries. Okay. So when we think about a shipping transaction, selling one good to a buyer with a ship intermediary, we can already sort of see or estimate the risks involved. If a seller wants to mitigate their risk, well, their best case scenario is cash in advance from the buyer, right? If the buyer delivers you a check, right, of $1,000 for what you're about to send them, and you haven't even sent it yet, you have a pretty secure transaction right there. Okay, go ahead and deposit that in the bank, and then you're golden. Okay, there's no risk. That's perfect for the seller. Buyers might not like that very much, because what does that promise back? What if the seller still doesn't ship the goods? What if they're defective goods, right? So what is the buyer's best case scenario? The buyer's best case scenario is the goods get shipped whenever, and I can pay within 30 days. That's called an open account. Okay, I've got plenty of flexibility on when I send my payment. Both the buyer and the seller are going to be at a stalemate, at a irresolvable disagreement, if one of them is not tremendously generous in granting the other their best case scenario. So let's repeat them again. Cash in advance is the best case scenario for a seller. An open account, the ability to pay within 30 days, is generally the best case scenario for the buyer. Okay. Neither of them are going to want to grant that to each other for a lot of obvious reasons. Sellers are going to be worried about their payment, and buyers are going to be worried about the quality and the shipment of the goods. So what is the solution? What is the great compromise between cash in advance or an open account? The answer is the using of a document of title and to perform a documentary sale. So first, let's figure out what exactly is a document of title. Okay. A document of title is something that we use in our own everyday life. Maybe not every day, but for the major possessions that we have. I have a title to my car, right? I have a title to my house. I don't need a title to my stapler, because if I'm going to sell my stapler to a person, I'll just bring them the stapler. I don't need some other document to prove I own the stapler, right? But I might find that pretty convenient for my car. If I'm leaving my car here in Oklahoma and I'm flying to New York to sell my car to a New Yorker, I'm just going to bring with me my title. Instead of, I don't know how I would pack my car into my luggage and bring it to New York with me, I suppose I'd have to drive it all the way there, right? No, it's so much simpler to just bring my title and sell it to the title to them. And that is an effective delivery of the goods. And then they can do with the car whatever they want from a distance. They can have someone come pick it up. They can sell the title to another person. The car never has to move, or the house never has to move. Whatever's represented by the title doesn't have to do anything. It can stay in a warehouse somewhere. And then people can barter over those goods represented by the title. Okay? So a title is an instrument signifying ownership of some kind of good. Okay? You don't have to be in immediate possession of the good. You just have to be in immediate possession of the title to have ownership. The goods themselves could be entrusted temporarily to what we call a bailee, which is a person who might have possession but not ownership. So let's use a more business law example than a car or a house. Let's say I have 100 bushels of wheat and I would like to sell them in the marketplace. Well, in the meantime, I have a bunch of bushels of wheat that I've harvested. What am I going to do with it? Well, I'd like to warehouse it or put it in a grain silo, right? I don't know what you do with bushels of wheat. I'm just spitballing here, right? I got to put it somewhere. So I'm going to pay a warehouser to put it in their back room, right? They are the bailee in that relationship. And I will have a title, maybe issued to me by the warehouser, and the title to those goods I can go sell, and the person I sold it to can go sell, and the person they sold it to can go sell, and whoever ends up with it and actually wants the wheat, they can go bring that title back to the warehouser and say, I'm the new owner, please unlock the doors. Okay? That makes business transactions convenient. Okay? And it makes it possible to do a documentary sale for an international shipping arrangement between a buyer and a seller. One type of title is called a bill of lading, and it's slightly different than my warehouse example. If I am a seller and I provide my goods to a carrier, a shipper of some kind, it could be as simple as in old days, 100 years ago, 200 years ago, it would have been something like this. I bring my cattle, my 100 cows or whatever, to the ship. And the captain of the ship gives me a bill of lading. And the bill of lading will have some details on it. It will say, the shipper hereby receives 100 cows from the seller, and this document hereby represents those 100 cows. Okay? Maybe it contains more details, like the cows are in good condition and they are young and healthy. Okay, that might be useful to include in the document. And then I have that document, and all the stuff gets put on the ship. I can go turn around and sell that document in the receiving country to whoever I want. Okay, I can sell it, and then it can be resold. And anybody who purchases that bill of lading has paramount title to the goods that are represented by it. This is important. Okay, when you purchase a bill of lading, the important part is that you get primary ownership of the thing represented by the document, despite anybody else's argument that they might also own it. Now, why might someone else come and say, no, those are actually mine? Let's use another hypothetical. Let's say, before I sold a person my bill of lading representing those 100 cows on a ship that's currently crossing the ocean, I went and I promised those things to another person. And I said, I'm going to issue them as collateral for a loan, right? Or I plan to ship them to a whole other destination. Okay, that person received a promise from me, but that promise will not be good against a person's properly negotiated for bill of lading. They will, no matter what, have the ability to show in court that they are the owner of that property. Okay, so a bill of lading is nice because courts will recognize your ownership despite anybody's liens on the property, despite anybody else saying that they also own it. Now, why would a bill of lading be useful to us in a documentary sale? And what is a documentary sale? Well, let's define it real quick. A documentary sale, we already know, is the compromise between the two extremes. the best case scenario for the seller was the cash in advance, and the best case scenario for the buyer was the open account, right? So a documentary sale is the transmission of goods from a seller to a buyer through some type of bailee intermediary, a shipper, okay? So we'll start there. It's the transmission of goods through that intermediary. Now, we're also going to throw in a bunch of other things in here to protect the parties, including banks and including other documents that accompany the bill of lading. Okay, so let's start going through some steps, and we'll see why this is preferable to the two extremes. You start with a contract between the buyer and the seller. And if you want an easy representation of this, turn to page 128 of your book and take a look at Exhibit 5.2. Okay, the way that I break this down is not exactly that A through G that's illustrated right there, but I think I can maybe even explain it better than they do. Okay, so I'm going to try and explain this documentary sale. You start with a contract between your buyer and your seller, right? It's the drafted document that says, I agree that I plan to buy these things. I agree I plan to sell these things. Here's the price that I'm selling them at. Here's how much of them I'm selling, right? And it'll say signed by buyer, signed by seller. That's your contract for sale. It might include other things like, in order for me to complete the buying process, I would like to be promised a whole bunch of promises, right? Or in order for me to complete the selling process, I want the buyer to also buy the insurance on the transport of the goods, so forth and so on, right? Everything that you want to throw into that contract that's appropriate, okay? Then, once you have that contract for sale, the seller of the property will bring their stuff to a ship or to a dock and acquire a bill of lading. The bill of lading is issued back to the seller once they've delivered the goods. It is a document that demonstrates ownership of the goods that are in the temporary possession of the transporter, okay, the shipper. Now, it proves that he owns them. And the shipper can then endorse that bill of lading to a bank on the shipper's side, along with all the other documents that the buyer might want in order to complete the transaction. What are the other documents included here? Well, the bill of lading itself, because they're going to want ownership of the property represented by that bill of lading, right? But they're also going to want other things. The negotiated insurance policy for the goods. What happens if the ship sinks, right? Who takes responsibility for that? Is it an insurer? Who pays for the insurance, right? So you might want a marine insurance policy included along with the transaction. What else? A commercial invoice that details all of the goods. Okay, that makes plenty of sense. A document called a documentary draft, which basically is the instrument that tells the buyer how much they're expected to pay and how to pay, okay? Or if payment's going to be done in an installment plan, how that might work. So that might be included. It might include any export licenses, such as the documents that prove that it's going to pass through customs. As a buyer, I want to know that the things that are being sent to me aren't going to be turned around at the dock by my government's customs agency because they're infected with lice. That's pretty important to me, right? So I might require that all as part of the documentary sale. And then lastly, and this is important for the seller and the buyer, you might require a certificate of inspection and analysis, okay? Why would you want a certificate of inspection and analysis? Well, the buyer wants to know if they're going to be buying this stuff because they see a bill of lading and they see all of these supplementary documents before they even see the ship arrive at the dock. They want something that proves that the stuff on the ship is good stuff, right? So the buyer might actually hire an inspector in the shipper's country, the seller's country, to go and look at the bananas before they even get put on the boat, or once they're put on the boat, right? To make sure that they don't have bugs on them, to make sure that they have the appropriate packaging that will prevent infestation or deterioration of the goods, to make sure that they are in containers that are properly sealed, right? So you might want, as a buyer, a certificate of inspection and analysis. And a seller might want that too, because they want to be able to prove to the buyer that it's good stuff. Okay? So those are a lot of your supplementary documents: your marine insurance policy, your commercial invoice that details the stuff, the documentary draft that tells the buyer exactly how to remit their payment, the export licenses that prove that the things that can actually make it through customs, and the certificate of inspection and analysis. All of that will accompany the bill of lading itself, which is the title to the goods. Okay? Then the next step is that the seller's bank sends all of this stuff, all these documents, to the collecting bank. We call it the collecting bank, but you could just call it the bank in the buyer's country. Okay? Now, once all of that stuff gets sent to the bank in the buyer's country, the buyer then remits payment. And they receive, once they remit payment, all of this stuff. They receive the bill of lading that gives them actual ownership of the things that are currently on the ship that might currently be in the middle of the ocean for all we know, as well as all the other assurances from the other documents. Okay, so we have all of this intermediary stuff taking place for the transaction, and it makes the whole thing sound rather complicated, but it is the middle ground between the other scenarios, the cash in advance and the open account. Okay, so when this stuff comes to port, the buyer already owns all of it. They already remitted payment for the bill of lading and the accompanying documents. Here's one shortcoming. Okay, what if the buyer sees this stuff that came to their bank and the ship's on its way across the ocean and they decide, no, I don't want to buy it anymore. We're going bankrupt, or I found a better seller in the meantime for some reason, or one of any number of things took place. Maybe it was just a shady deal to begin with. Okay, there is something that the seller can do to protect itself, just to tack on to the documentary sale to make it an even better documentary sale. And it's requiring a letter of credit from the buyer prior to even the getting of the bill of lading, before even bringing the goods to the dock, right? So if you require a letter of credit from your buyer, it is the buyer's bank being authorized by the buyer to buy it for them and proving that they have the money to buy it with. So the buyer will never be able to back out, because their bank is going to hold on into kind of a trust account the money that it would take to make the purchase. So a lot of times you have sellers that will say, willing to negotiate with any buyer so long as they provide a letter of credit and that we will perform a documentary sale, right? So that's kind of a very routine demand in the international shipping business. All buyers must provide a letter of credit so that I know that you're good for the payment, right? And then buyers, on the other hand, will have their own demands. I would like to have the inspection and analysis. I would like to have a marine insurance policy. I would like to have a commercial invoice. Okay, so documentary sale. There's a lot of steps to it. They're illustrated in Exhibit 5.2. And it is the good middle ground between the two extremes of cash in advance and an open account. Okay, what are the types of a bill of lading? There are a few types. I'm not going to cover all of them, but these are the ones that are relevant to the class. A clean bill of lading is one that has no notations by the shipper, the so-called carrier of the goods, the bailee, if you want another title for them. A clean bill of lading has no notations by the carrier about damage to the goods. So this is the goods upon delivery to the ship. The seller brings them to the dock, they're getting loaded onto the ship, and somebody is writing out the bill of lading. And while they're doing that, they're going to look at the goods and they're going to note, a few of the containers have rust on them, or a few of the bushels of bananas have a few insects. Okay, and that will be permanently inscribed on the bill of lading. So anybody it gets sold to, and obviously a future buyer or a buyer who you already have a contract for sale with, they're going to be very, very interested in whether it's a clean bill of lading or if it has some notations. If it does have some notations, it's called a foul bill of lading, okay? And nobody ever wants to buy a foul bill of lading, or it could reduce the value of the sale at least, right? Now, one thing to know about even a clean bill of lading is that does not necessarily mean that things will not happen to the goods during transit. It just guarantees that the goods were fine at the very beginning of transit. So if during transit the bananas become infested with lice, well, you still could have bought a clean bill of lading and then still received defective goods, right? So you might want to put into the contract what happens about in-transit stuff. Is the carrier liable for that? Is the buyer liable for that? Is the seller? All depends on your contract, right? What is a on-board bill of lading? There are two places where you can get a bill of lading. Some people will get it at the dock before it actually gets put on the ship, and some sellers will go ahead and get their bill of lading only once it's actually on the ship, and that's generally seen as a more valuable bill of lading, okay? If you are a buyer, you generally want a so-called on-board and clean bill of lading, which shows that at the time of it actually getting on the ship, the goods were clean, no defects, no notations on the bill, and they were actually probably getting ready to leave the dock, and they're not going to sit there for a while. If you're a buyer who's willing to accept the other type, which is a received for shipment bill of lading, it means that, for all you know, the stuff sat there at the dock for a while. It would be very unusual for a buyer to agree to a received for shipment bill of lading that is for an expirable good. If you're buying bananas, you definitely want the on-board bill of lading, right? On the other hand, if you're buying, I don't know, steel, I guess it could still technically rust, but it might be less expirable, right? Bales of cotton, I don't know what would cause it to expire, so probably more reasonable for you to go ahead and accept a received for shipment bill of lading. But the difference between the two is exactly where they're issued. Was it issued at the dock, or was it issued on the boat? Okay. And what is a straight bill of lading? Well, a straight bill of lading is compared to a negotiable bill of lading. So a negotiable bill of lading can be bought and sold. I can put the stuff on the boat, have my bill as the seller, and then go sell it to someone, right? But a straight bill of lading will say right there on it that it can only go to one specific person, okay? It can't be bought and sold because it can only go to one specific person. So it is non-negotiable, non-transferable title. The goods will be delivered to that person no matter what, under captain's orders, right? Another thing that you'll want to care about when you're drafting contracts is the risk of loss. Now, one thing that's important under the CISG is, unless you specify otherwise in your contract, risk of loss is already allocated, okay? From the placement in a mode of transport, whether it is shipping, flight, trucking, whatever it is that the seller's bringing the goods to put it into transit, at the moment it enters transit, so it gets put on the boat, it gets loaded onto the plane, whatever, at the moment it enters transit, the CISG says the risk of loss, damage to the goods, a crashed plane, a crashed boat, the risk lands on the buyer, okay, at the moment it is placed in transit, unless your contract specifies otherwise. Maybe you want to agree to something else, but this at least lends consistency to who gets the hurt if the mode of transport fails for some reason, okay. The risk of loss is on the buyer once it is in transport. So this is why buyers care an awful lot about whether the goods are insured for their shipment. Has someone at some point in the transaction bought insurance on your shipping? If I'm going to load 100 bales of cotton onto a ship and ship them across the ocean, you bet that I'm going to pay a little bit of a fee to somebody to insure that just in case they get destroyed. Part of your contract for sale is going to have to allocate who pays for that. Maybe it's the buyer. Maybe it's the seller, but it's going to be the buyer that cares more because they're at the greater risk of loss. Okay, it's on them. And then obviously, as part of the way that that gets negotiated, if the seller is going to buy the insurance, then that generally means that they'll increase the price to cover the cost of the insurance. If the buyer is going to buy the insurance, then they will maybe demand a lower price from the seller to make up for that difference, right? So it really just depends. Somebody's going to pay for it either way. Maybe they'll both buy it jointly. That's rare, but it sometimes is done. Generally, as just kind of a course of practice, sellers make more promises than buyers. Why? Because sellers want to sell their stuff, right? So sellers will tell buyers, hey, we'll do everything for you. We'll buy the insurance, we'll arrange for the transport and the costs of shipping, and all you have to do, buyer, is pick it up at your port in your country. But what the seller will do is they'll say, now, we'll just include all those things on the invoice. The cost of the insurance, the cost of the shipping, right? Buyers, well, they might want different things. They might want sellers to, okay, tell me both options. How much would it cost if I paid for all those things and I just wanted to pay you for the goods? And then how much would it cost if you did take care of all those things, the insurance and the shipping costs and all that? Then they can choose from a menu of options, okay? And it helps over the course of negotiations to have those things listed out. How will your contract's terms be interpreted? That's kind of the last part of Chapter 5. When you get into the, what are the E terms? What are the F terms? Don't get too into the weeds on this. Here's what we're really talking about when we're talking about terms of trade. When you are writing your contract, you might have a preface clause that says, all the words in this contract are to be interpreted in accordance with blank. And then fill in blank with some pre-existing document in international law that favors either neutral interpretation of terms, interpretations that generally benefit buyers, or interpretations that generally benefit sellers, okay? So you have some different options to choose from when you're deciding exactly which types of terms you would like your words to be interpreted by, or you can actually go through the lengthy process of defining all of your terms in your contract by attaching a page of definitions. It's kind of up to you, but the trade practice in the industry is to just go ahead and use the Incoterms, already pre-existing definitions in international law that have existed since 1936 and were renewed in a new document in 2011. So a lot of contracts for sale will say something along the lines of, this contract is to be interpreted in accordance with Incoterms, right? And then you might choose some subset of values to those terms. So what would be an example? Because this gets kind of confusing. An example would be, what is a ship, right? If I have a contract for sale between a seller in the United States and a buyer in the United Kingdom, and it's a very simple contract, it doesn't have its own definitions in it, and it just says, seller will put these things on a ship and send them to buyer, okay? Well, ship might actually become in contest at some point. What if something happens? What if the ship sinks, right? And the question is, who's liable? Who made a mistake? Did the seller make a mistake by putting it on the wrong kind of ship? Well, it depends on how you decided you wanted your terms interpreted, right? So you could have agreed that ship means a safe ship with a licensed captain that is suitable for international transport, right? If you're interpreting your contract that way, well, then it seems like the seller has an implied promise to choose a good ship, and that they might be liable if they didn't. On the other hand, if you agreed to a set of definitions that is kind of more relaxed and doesn't seem to interpret the word ship so strictly, it could mean any kind of ship, with any kind of captain, licensed or unlicensed, safe or unsafe, then the buyer might actually be liable because, well, They didn't specify in their contract that the seller should have picked something more specific and something more safe. So the definitions of the terms in your contract matter an awful lot, right? What is a ship? What is insurance, right? Does insurance as a word mean covering all of the cost of the goods in case they are damaged? Or might insurance be a more relaxed word that means covers incidental damages but not total loss? I don't know. It depends on how you interpret terms in your contract. Two ways of defining terms in your contract are actually define them in your contract. That's one option. And the other option is to just have a clause in there that says all of our terms in our contract are to be interpreted in accordance with, and then choose some arbitrary standard. Incoterms seems to be the industry standard, and even if it's not used, will generally be imposed by courts as the customary standard. Okay? So all of that might be useful for you in answering this week's discussion board post. Otherwise, good luck to you on completing assignment 4, this week's discussion board. Next week will be more interesting because you will get to choose what your 5-page midterm paper topic will be. I will send to you a list of possible topics as well as sources that you may use in the writing about those topics. You can also do, of course, your own external research if you want to add a couple more sources, which I would encourage. But I think it's helpful for me to go ahead and narrow the topic list down in a class like this, where it can be hard to nail down a specific idea for a paper or a 5-page paper. So I will give you a list next week of possible paper topic options, and you'll have several weeks to complete that paper. All right, that's the end of this lecture, and thank you.